what I want to bring up is that the latest part of this inversion that we've seen over the last few months. So in April, in March, when Silicon Valley Bank was happening, we primarily saw an inversion coming from the 2 year. So that was an expectation the Fed would lower interest rates in response to the small bank crisis. But now we're actually seeing it from the long end, and that worries me substantially more. So, there's two ways in which it can happen. You're looking at the spread between the 2 year bonds and the 10 year bonds. So let's say the 2 year bonds are at 5.5, just like here, and the 10 year bonds are at 4.5, right? So that's a 1% spread. And usually the inversion can happen in two ways. The 2 can either fall or the 10 will rise, right? So in March, we've seen the 2 fall and the 10 was falling, but not as much. But now what we're seeing is the 30-year and the 10-year are rising very quickly, and the 2 year is rising slowly. That creates massive tightening on the economy because so much debt is actually tied to the long end, mortgages, mortgage-backed securities, and so much transaction in longer-term debt. And that's starting to hurt the banking system, and that's starting to hurt lending quite a bit. And historically speaking, when we see the bear steepening, that was when things were most likely to tighten significantly.
And is that what we're seeing right now?
Correct. So the latest move from negative 100 basis points to negative 60 basis points in the yield curve was all led by the long end. And primarily because the market capitulated on the Fed higher for longer, they're starting to believe the Fed, which is very interesting because when that happens, they're selling off the long end, and that usually leads to the end of the tightening cycle because then the economy just contracts and the Fed has no choice but to lower rates.
So given the nature of this steepening curve, does it lead you to believe that a credit crisis is more or less likely? Does this type of steepening have an influence there?
Yes, I think that it makes a credit crisis substantially more likely. I think we're going to see an additional banking crisis that may be on a order of magnitude bigger than what we saw in March with Silicon Valley Bank, order of magnitude. But it's probably going to be in 2024.
Got it.